Welcome to Leaders in Lending. I'm your host, Jeff Keltner. This week's episode features my conversation with Kristina Schaefer, the General Counsel, Chief Risk Officer, and Chief Administrative Officer at First Bank and Trust. Kristina and I got to geek out for a minute over a recent event in her state where the governor has vetoed updates to the UCC, and I thought that was fun. I always enjoy a good policy governance wonky geek out, so that was a lot of fun. We dove into some of issues around human capital, which is a chief risk officer. She considers one of the larger risks of the institution and how she thinks about that risk and mitigating that risk. We also talked about how she thinks about the role of a risk officer, in kind of a compliance team in terms of enabling innovation versus being roadblocks, how you support and enable that capability. And so that was, I think, a really interesting perspective to bring. We hear so much on this podcast and often in the innovation space from people at the line of business or the technology side, but understanding how to partner together and how to think about some of these updates to laws or some of the ways you can work with the compliance team and how a compliance or a risk team can think about their role in fostering innovation was really fascinating. So I enjoyed the conversation and I hope you will also. So please, without further ado, enjoy the conversation with Kristina Schaefer. Kristina, welcome to the podcast and thanks for joining me today.
Yeah, thanks for having me.
There's an old, a Chinese curse? They say, may you live in interesting times. I think I feel like we live in interesting times. So I wanted to start with two categories of questions. One, you own Risk, if that's correct. Yes, Risk?
Yes, Risk.
The last week or two have seemed like the nature of risks have shifted or maybe changed. How has your perspective on risks or risks that weren't on your radar come on your radar? So, how has that shifted in the last couple of weeks? And specifically, depending on when this thing publishes, we're talking about the failure of Signature Bank, Silicon Valley Bank, the fear of contagion and run on other banks. It's a pretty big shift. Or I think it's caused some people to think some things are risky that maybe they didn't think were. And I'm curious your take on how it changes your perspective.
Yes, I think that's true. I think for a long time, it's been since 2000 since we had a bank failure. And I think what this recent failure, particularly with Silicon Valley Bank, demonstrated was just the power of quick communication that also exists now that didn't historically. We saw the news start to spread fast. We also saw the role that good PR and maybe bad PR can play in fueling something like that. The timing of the events of last week with Silicon Valley's failure were just interesting, with Silvergate announcing they were planning to liquidate, the announcements that were coming out that they lost all this money at Silicon Valley and they were going to turn around and do a big capital raise. That's an interesting timing. And it caused widespread panic. And I think, from a bank perspective, we always pay attention to liquidity, but banks have been enjoying being flush with deposits for the last several years. And now as the economy kicks back up, people are pulling money out of their deposits because they need it to run their business, notwithstanding, of course, the other issues that maybe were a little bit unique to those two banks in terms of what was in their portfolios.
They had.
Yeah, exactly. And I think concentration risk is just going to continue to be critically important as banks look at their loan portfolio. What percentage of your deposits and loans should be in which particular industries? And, we've always looked at that, but I think now you're going to pay very close attention to it because that's what's catching everybody's attention now. They had 25% of their depositors in this, or they had 50% of their depositors in that. And, that's good metrics to know and to know where your bank is at.
We might need to know the percentage of our depositors that follow each other on Twitter, what the web looks like in terms of how that contagion, I think, at a Silicon Valley Bank was at least exacerbated in terms of people pulling out the funding.
The actions over the federal government over the weekend, I think, were helpful in some respects because certainly it calmed the waters with all of those people who were tweeting prolifically about their loss. And of course, I understand why they were. Many of those people were worried about making payroll, different things like that, because they didn't have access to their funds. And if you think about large, complex commercial customers, to pay your staff, you probably have more than $250,000 in any one bank. So I understood the fear and why it ramped up so quickly. But I do think the actions over the weekend did calm the waters a bit. People didn't think they were losing millions of dollars. So that Monday, when the rest of us opened, we weren't seeing the fallout that I think perhaps we would have seen had they not taken those actions.
I think the other interesting thing about the run here was just how rapid. I mean, 25% of deposits coming out in one day. And I feel like that's exacerbating a concern I'd heard from some institutions, which was this increasing rate sensitivity on the side of depositors. That like people were pulling their money out because I'm getting emails all the time from SoFi or whoever else at 3.5% on a checking account, which is, I mean, I'm not that young, but like getting more than 1% just feels absurd to me on a checking account. Now you got people offering 3%, something like that. And the sense that this is kind of combining in a world where the safety of deposits just isn't maybe what it used to be, both in terms of how much I have to compete for them, but then how quickly they could shift a different direction for whatever reason, whether it's fears about the bank or the banking industry, or it's, some sense of like, hey, there's some guy over here offering me a little bit more money. I'm going to go take advantage.
Yeah, I think that's absolutely true. Technology and the ability to open accounts online as well as email marketing just makes the market more sensitive to people being able to pull their deposits more easy, maybe is the better way to say it. When I first opened my checking account, I would have had to walk into the bank, give them all my information, and now you can click a couple buttons and transfer the money out. So that, was an issue, I think, most recently. The other thing is people are not as sticky as they used to be. And some of that does, people they will go somewhere for a better rate. They might leave some money at your bank, but people do rate shop. But it's a lot easier to rate shop now because there's information everywhere. You're either getting an email or you can look online and compare rates. I mean, there's big billboards and whatnot too, but it's just very easy to compare rates right now. And then as a bank, do you match everybody's rate? What do you do in that situation? Competition for deposits is suddenly very, very fierce.
Yeah, it's gonna be kind of a new world. It's not been our normal. Let me shift topics a little bit. I know your governor recently vetoed the UCC amendments. I think, tell me a little bit about the background on that for anybody who's not as familiar, and then your perspective on the change there.
Sure. So every so many years, the Uniform Law Commission comes out with suggested revisions to the UCC, the Uniform Commercial Code. And they recently came out with revisions in 2022 that are out in many state legislatures now, I think 20 or 30, something like that, just depending on your legislative cycle. And a lot of the updates were to address things like emerging technologies. And so one of the main things that this bill did is people had a hard time lending against Bitcoin, about taking Bitcoin as security for a particular loan, just because of the nature of Bitcoin. A lot of people don't, right now, Bitcoin is a general intangible from a UCC perspective. And the way you perfect your security interest on a general intangible is you file a financing statement. Well, people who have Bitcoin, they don't want a filing statement out there saying that they own this Bitcoin for a number of reasons. And the only other way to do it is to take control then, which that's a little bit difficult for a bank to take control of this. So one of the major updates to the UCC was defining things like Bitcoin and cryptocurrency as CER or CRE. No, make me sound smart there. I can't remember. Oh yeah, CER. I have to stop and think about what it sounds. You can edit that out. Because they wanted to improve the negotiability of Bitcoin. The other issue that was happening with Bitcoin is if someone would have encumbered your Bitcoin, there wasn't a great way to track it. So it also, under the current UCC, was more difficult for there to be a market. There was a market barrier to the transfer of Bitcoin. So that's, the main thing that came out of these amendments. There's some other things that were updated. Just like several years ago, we talked about faxes, then we talked about email. A lot of the UCC still talks about paper, and there's not much paper anymore. But what has come out now is there's a certain segment of the population that actually believes that as a result of this, that the government will have more information on your records. There's a very big segment of the population that believes this is some kind of way for the federal government to understand everything that you're doing. The other thing that happened with this UCC amendments is it defines money, and it does talk about a central bank digital currency. It contemplates that but we don't have one. Other countries do. Until there's a federal digital central bank digital currency, that doesn't really matter. A state can't start their own central bank digital currency. But I think these people also believe that these amendments will create this central bank digital currency, which is problematic for a number of reasons. And it's just not true. I think people are worried about the definition of money. Who thought we'd be arguing about that? But money, for purposes of the UCC, has a specific definition. I think people just maybe don't understand what the UCC is and what it isn't. The definitions used in the UCC are really about how banks make loans, how commerce transfers. It doesn't change the definition of money across the nation for Bank Secrecy Act purposes, for anything else. It's just about commercial transactions. And our governor believes some of those arguments and has indicated that she believes it's a freedom issue. And I disagree. I don't think it is. Our governor has always taken a lot of pride in being a business first state. And, we want to make things easy in South Dakota for people to do business. And if we're one of the only banks that doesn't end up adopting the UCC amendments, I think the exact opposite will be true. In fact, I think had we passed or had she not vetoed the UCC amendments, I think it would have been a good thing, because it would have permitted us to take security interest in Bitcoin and eliminated all those barriers. So here we sit. If you would have asked me last year what issue I would be talking about from South Dakota's legislative session, it would not have been whether we should pass the UCC. No. And it's like a bank lawyer geek moment for me, because this is combination of my legal background and my bank background. But I think that is a little bit of a disadvantage, because it allows misinformation to be circulated very quickly. People just don't understand it.
Interesting. Yeah. Tell me a little bit, you talked a lot about Bitcoin and cryptocurrency in there.
Mm-hmm.
What, are you guys doing things in crypto? Where do you think community banks ought to be when it comes to engaging with crypto? It's such an interesting space. Obviously, we talk a lot about Silicon Valley Bank because it was the larger of the two banks that kind of failed, but the other was Signature Bank, was really closely aligned with crypto and being the back end for a lot of crypto services. What's your sense of where banks are at and what you guys are doing, or what you think is interesting in the crypto space for banks these days?
Well, there's a lot of regulatory guidance out there, and I think some banks, don't know whether they should do it. I mean, I think there's a lot of fear surrounding the crypto industry just in general. What risk does it actually pose to the bank? But I think a lot of that depends on how a community bank might be using it. Maybe cryptocurrency is an asset that someone can have as part of their 401k, or sometimes maybe a crypto mutual fund, things like that. I think the custody of crypto assets is probably the actual issue that most community banks, frankly, just from a technology standpoint, aren't capable of doing right now. But if most community banks were to pull their records, their customers are buying and selling cryptocurrency. They probably have customers. We have in South Dakota, we have Bitcoin miners. We have people who are, I don't know if energy is cheap here, but we have those businesses. And in fact, in some of our communities, they love it because they're like making all sorts of money on the electrical bills, a rural country because of these Bitcoin miners. So, I think it's going to be a slow adoption in many of the community banks. And if they do, I have heard of some of the core providers linking up with a way for customers to buy crypto. So you're linking through the bank, but it doesn't actually really impact the bank. It's just a way for people to buy crypto. Yeah. Yeah.
It's the whole crypto custody. I mean, the real crypto hardcore folks are like, if you're not self-custodying with like a hardware wallet, then you're not really doing crypto. And I go, well, then the average consumer is probably never doing crypto.
Right.
That's the requirement to really be in the game. And I think a lot of it is just how do you make it accessible. So one thing Coinbase has done very well, I feel like, is like, hey, I can like just, you can go through the MetaMask route and have a wallet and do that. But, you can go to Coinbase and just go click.
Right.
Like,
there
I own some Ethereum. I own some Bitcoin. I own some whatever. And it feels much more accessible. I feel like that's I won't say necessarily underappreciated. Many in crypto do appreciate it, but certainly when I hear they're like, you don't have your own wallet, you don't self custody. I go, I haven't self custody my cash either.
Right. Well, back to our earlier topic. I think one of the interesting things about crypto is people generally, although some people are both camps, fall into two camps. One is it's a useful investment tool. It's an asset. You buy it because you hope that it'll appreciate in value. And then there's another camp who really thinks that they should be able to pay for everything with cryptocurrency. They focus more on it being used as a payment mechanism. And I think sometimes the goals of what you're using cryptocurrency for differ. And so how banks would approach it would be different. There's probably the third group too, right? That think of it as a stable store of value to replace currency, which is kind of counter to the asset. I mean, at some point, for that to be true, hey, this is a great asset that keeps going up in value. Like, it's not a stable store of value if it's going up a lot. And as long as it's going up a lot, it's going to be subject to also coming back down a similar amount. So when you think of it as a replacement for the dollar as a stable store of value, you got to get to a place where the price isn't accelerating or decelerating in dramatic ways. And so that's the other thing I hear. I definitely hear the payments. I hear hey, I'm buying it because it's going up and people made a bunch of money. And then the real hardcore people who think this is the future really view it as like a better replacement. Something will be more stable than the dollar eventually. It's obviously not where it's at today, but that conceptually it should have a framework that is not subject to inflation, to central bank changing interest rates, as we've seen, that shifts the value of your money in dramatic ways outside of your control, that it should be a more stable store of value if it works the way it's supposed to. Whether or not it's there now is a different question. But that's I think a third camp of people who really believe in this as the future of, the way we store value. Yes. In fact, as we've been debating this UCC information in South Dakota, a lot of the people on social media and whatnot are talking about the fact they're saying, I am a bank. And this is going to make sure that I still have my money when, kind of the world crumbles or the banks all fail. And it's an interesting approach for those hardcore folks.
Yeah. Well, I own Bitcoin, but not enough to have thought that it's a better store of value. At least not yet. Anyway, I'm going to shift totally to a different area, which is you have an interesting role in that you are in charge of risk, but also HR, which is, I think a slightly different area. But you did describe to me when we were speaking earlier that you some ways view people in HR, not HR like activities, but like the human capital is one of the greatest areas of risk in the organization. So I'd love for you to dive into what you mean by that and how you think about the importance of people and how you manage what kind of risks around that and how you manage them.
Well, we do at our bank say often people are our most valuable asset. And as a result, your asset is subject to risk. You have to take care of your asset. And I think we've seen that particularly COVID accelerated it certainly a lot, where people can work everywhere, basically, for most companies. And so as an organization, we are competing for the best and the brightest people from not just banks down the street or a town over, across the country. And so not only do we have to constantly be thinking about attracting new talent, but I think a lot of times people miss talent retention. You can attract people sometimes, but you need to make sure with attractive benefits or good interviews and a good sense of community, but you need to make sure that you're retaining people too. And one of the things that I think has been interesting is we've watched kind of the shift in employee wants and employee needs is, some set of benefits will appeal to some people, but if you, maternity leave, for example, if you have no plans to have children, is that an attractive benefit? And if not, what's comparable? What's important in your life, and what is your employer doing to support your interests there? Whether it's maybe pet insurance or, financial support for you to take care of getting an advanced degree, or maybe leave to take care of an aging parent. So I think you just have to be constantly thinking about people, because at the end of the day, we can't do any of the other things we've just been talking about without people, at least not yet. I mean, I know there's AI and whatnot, but we still need people to do the majority of things in a bank. So you need people. And I think a lot of times, because of our focus on technology and whatnot, you start to lose sight of the people that are needed to run an organization.
I want to ask you a slight shift on that because I love
Yeah.
the focus on people and retention. But one of the things I was told, my first job was at IBM, and I was told by somebody when I joined that, it says people often join a company, but they leave a manager or a team, meaning that those benefits, the 401k looks good, the salary is good, but then like my real experience at the company is mostly about the person who manages me, the team I work with, the day-to-day experience of it's not the kind of the general benefits. And that often it's that kind of individual experience that matters the most in terms of retention. So I'm curious how you think about the risk on that level, because there's the kind of benefits which often can be important. Like if I'm having a kid, I don't have maternity leave that I like it just may not come back.
Not a benefit, right?
It does. But on the flip side, I think how you manage training employees, managing culture so that people are enjoying their day-to-day experience is often equally, if not more important in terms of retention and employee morale and satisfaction. I'm curious how you think about that on that level.
I think that's absolutely true. I think company culture is also just as important as your managers, but maybe that your managers are embracing company culture. Somebody has said, it doesn't matter. It doesn't matter what's on the wall. It matters what's happening in the halls. And I think that's true. A lot of organizations have very great culture statements, very great, but you need to make sure that you're living them. Otherwise, there's no point in having a culture statement. I think that the role of a manager is increasingly important because there's just not that loyalty. You don't hear about people working at the same place for 40 years, so people will leave their manager. And so as a manager, you're going to have to learn to manage different. If you have teams that are fully remote or primarily remote, that's a different style of management than we've been used to in the past. I think the other thing that we find is people genuinely want to feel valued. And for a long time, that was money. And I think there's still a role that money does make an employee feel valued, but they want to feel seen and they want to feel heard. And previously a lot of managers, this is your job, you will show up, you will do it well, and you like your manager. But now I think it's more about listening to your people, even if you don't agree with what they're saying, but making sure that they feel heard and that they feel like they have an input into the company. And that's just a definite shift, even from when I first started in banking, in order to be successful. Because if people feel like your manager doesn't care about you and they're treating you as a cog in the wheel, what use is it to stay there? You want to feel like you're bringing value to the organization and to the community. I think we've also seen, particularly with this next generation, is, they care about the community. They care about the world that they're living in. And they want to know what the corporation or what the bank is doing to support the community, whether that's through volunteer donations, reducing recycling even. Are you recycling at your bank? That's just increasingly important to people as well. And I think sometimes it's easy for people to, we're a community bank. We've always done that, which is true, but you need to toot your own horn a little bit in terms of making sure that everyone understands the good work that you're doing. I think a lot of banks are kind of humble that way. I think we have to be more articulate. Don't go out and brag about it, but you can be articulate about the good work that you are doing, because that is very important. A lot of people entering the workforce, they want to know they're working for a company that does good.
I love that. And I love that phrase, what's happening in the halls versus what's happening on the walls. That's a great description of the mission statement, the inspiration poster that's on the wall that tells you what's supposed to be. But that's not, I was talking to our HR leader the other day, and she was making the comment that you can write whatever you want on a sheet of paper, but ultimately culture is what you do. And writing something on a sheet of paper if it doesn't change the incentives, what's rewarded, what's punished, what's accepted, what's not accepted, right. Then you can't change culture by writing a memo unless you're actually going to live those values in some way and change the structure of how you do things. I think that's a great point. And the other thing I wanted to riff on was you made the comment about your involvement in the community and helping your employees. That I've also found that it's super helpful to help employees see, stay connected with how their job helps your customers. Because sometimes you can be in this kind of back office, or even your customer facing, you're saying, I got to take so many calls. I've got, but you get your queue and your satisfaction scores and your wait time and whatever, and these kind of metrics. And you can lose the connection of how your job helps the institution serve a customer, a member of the community in a real way. And I feel like that connection is equally important to feeling value and purpose in your role, is saying, like, how does what I'm doing connect to? I see this a lot for our machine learning people or our data science going, well, it's a numbers game. Well, no, you're helping people get access to credit. That's what you're doing. And you're helping manage the investment assets. So like, those things are important, but it can be easy to lose sight of that connection between your day to day and the customers that are being helped by the services the institution offers.
I would agree with that 110%. I think particularly if we think about banks, 30 years ago, almost everybody was touching cash or, running checks through and talking to customers. Now, if you think about how banks operate, a large portion of, how the bank actually runs is not done. They're positions that nobody, frankly, outside of the banking industry knows that exist. They're not aware that there's, huge IT departments or large compliance departments. My role is difficult, and then I do, risk. You have to be deliberate about understanding and sometimes connecting the dots for people, because, the compliance team is reviewing a truth and savings disclosure. Okay. But what does that mean? How does that tie into the bank's growth goals? I'm drafting a loan document. I think one of the easiest ways, though, to kind of combat that back office versus, frontline customer facing role is to just be deliberate in communicating and to bring the people along with you in the bank's successes. If you have a big loan closing or loan growth, make sure that you're also being cognizant of the people in loan operations, or that, reviewed the documents or helped you with the closing, ordered the appraisal. Because sometimes I think people lose sight of that connection to the bigger purpose. And then I think as an organization, you have to be deliberate about why banks are good for the community. Because otherwise people just see it as, yeah, we do loans, we do deposits, right? But in many communities without a bank, small businesses wouldn't start, people wouldn't buy their first homes, people couldn't save for college, they couldn't plan for retirement. Like, banking is one of the few careers that impacts people on almost every, point in their lives. And so you have to be very deliberate in helping to connect the work that these people are doing on a daily basis to that simple fact. Very few industries can say that. Banking and, lending can. But sometimes it's just easy to lose sight of that when you're, like you said, answering 75 phone calls, or you're, reviewing 17 different marketing ads. You have to really stop, and if someone doesn't understand it, point it out to them, or let them celebrate the success of the ultimate customer result.
Yeah. I'm about to, right after this, I'm going to go to our all hands meeting. And one of the things we do here at Upstart that I think is really helpful is they read a borrower written review every week to the entire company, and we kind of pull them out because, we get reviews written good and bad. But I think oftentimes it's, I'm getting this loan to help me X, pay off a bill I didn't expect, or pay for this thing, or I'm getting out a credit card debt. That connection to, that's a real human being whose life was impacted by the services that you're offered, I think is really important to help us stay aligned to not just like what you're trying to do, but the purpose and the why behind what you're trying to do and how you're helping people. And I enjoy that every week. I look forward to listening to that being read. It's a fun way to stay connected to the mission.
It is. We had a fun experience recently where a member of our fraud team, which is normally kind of a back office, and I hate using that term, but non-customer facing role sort of position, they went out and did training in one of our communities, and we were talking about scams. Well, a couple days later, this customer comes in and they have somebody on speakerphone. They walk into our lobby. They're like, this is what this employee was telling us about. Like, it's actually happening to me right now. And it was amazing, right? Because that was a real example when, like, literally a couple days later, this customer, we're not happy the customer encountered the scam, but it just really allowed that person in fraud to see what a difference their training made as this person walks into the bank with the scammer on speaker. And they were like, hang up.
Going,
yeah,
I've got a scammer here trying to take my money and I'm not going to let him. Right. Oh, that's great. We're running short on time, but I did want to ask one other category for you. It's something I love to ask people in the risk role generally, which is how you think about your role in relation to the lines of business, the other parts of the organization? Because I feel like sometimes risk, and it kind of sits like with legal, can get a bad name where it's like, well, those are the guys who say no and make it hard to do all the stuff we know we need to do and want to do. And the kind of like the obstructionist to innovation sometimes is, and I'm not trying to put that on you, but I think that can be the perception people have of risk. And so I'm curious how you think about, your role in engaging with the other parts of the organization to keep a positive and to be a good partner to them versus, being an obstruction to things getting done.
The Department of No. Yes, I am familiar with that characterization. I approach it in two separate ways. One, in order for an organization to be successful, you have to have asset generators and asset protectors. Because if you're just generating assets and no one's coming along the back end to make sure that you've got appropriate controls or reviews and whatnot in place, your organization is not going to be successful. So you really do need both just to counterbalance each other. I always say that if people think that, the compliance team, if everything they're sending is getting approved, that's probably not great. There should be some natural tension there, and that tension should exist because you have different overall goals. But the top goal is protecting the company. And that's the goal we're all working towards, is to have a successful company. Some of us do it by generating revenue. Some of us do it by protecting it. The other approach I try to take is really to be a partner and explain the why. I think a lot of times where people in risk sometimes get that attitude is they're just like, well, no, which I understand. But if you're there and you're like, well, have you considered this? Would this work for, this particular customer situation? Could you say it this way in this particular ad? If you give people options or ways to help them problem solve, then they're going to see you as more of a partner than just saying, that's not approved. You can't do it that way. I think the other thing that is helpful is, honestly, sometimes I think people think that like you made up that particular rule that you're citing. Like, you did not, right? Your congressman or woman. I think that's also helpful. Like, if you just empathize with them, I know this is a pain. I'm sorry, this is what the law says. We're going to have to just work through this together. People just, again, want to be heard, and they want to understand the why behind your taking the position that you are. Mm-hmm.
Yeah, I love the why. And it is the you're not the rule maker, just the one there to. When we started the business, we had this rule for a while, this goal of like keeping our CEO out of jail, which was a bit tongue in cheek. Nobody really thought he was going to jail. It was kind of like, let's not screw up so bad where, we got a regulator knocking on the door going, what the hell are you guys thinking?
Right.
Or, somebody knocking on the door from the federal government or a state agency going, what on earth were you guys thinking? So you need those people to protect it. They really, it feels like very personal protection when you're starting from scratch. But it is an important role.
It is.
Well, Kristina, this has been a great conversation. I get 3 questions I ask everybody at the end of the podcast. So now's your turn. Here we go. 3 questions. Number 1, what's the best piece of career advice you've ever gotten?
Just to show up as the best version of yourself every day. Just show up as the best version of yourself. It's easy to get distracted and to take a bunch, every day is a new day. Just show up as the best version of yourself that day.
It's good. I give that advice to my kids every day.
Right?
It sticks every now and then.
Right.
All right. Second question. What's the best piece of advice you've gotten about the banking space in general?
It's a marathon, not a sprint. I think it's very easily to get discouraged or to focus on one particular problem. But my bank has been around since the Great Depression. It's a marathon. We make decisions every day. Some of them are based on what's good right in that moment, but most of all, it's a long-term play.
Yeah, I like that. It's a marathon, not a sprint. And last question, what's one bold prediction for the future?
I think we're going to see more banks partnering with fintechs and more banks looking outside of their core providers for solutions and banks looking to solve problems by additional relationships. Instead of relying so heavily on their cores just to solve their problems. That's an interesting statement. And it always reminds me, whenever people talk about the fintech bank relationship being like this as a new trend, and I go, well, the cores are kind of like the original fintech. Right. It's been around for as long as there's been technology in banking. There have been financial technology providers who provide solutions to banks and credit unions.
But it is interesting to think that it's been a somewhat not super recently, but for a long time, it was a relatively stagnant set of players that were providing. And now you've got a lot of, I don't mean that in a negative way to the cores, but it was a small group that was kind of pretty stable, maybe a better word. And you're seeing a lot of entrants in that. And will be an interesting space to see evolve, because there's, I think, a lot of opportunity and maybe no faster pace of innovation than we've seen in the last handful of years.
Yeah, somebody said last year or 2 years ago at ABA convention, the pace of banking has never been this fast, and it will never be this slow again. And I think that is 100% true, particularly as you look at, just solving problems. How are you going to solve this problem? Are you going to partner with a fintech to do it? Or are you going to wait for your core provider? And is, frankly, that the best product for your bank? I think that's what we're going to see in the next year or two.
Excellent. I love it. Kristina, thank you so much for your time today. This was a great talk.
Yeah, thank you.